This house is in Austin, Texas. It was listed 120 days ago for $650,000. 3 years ago, in 2022, this house would have had 15 offers in the first weekend. There would have been a bidding war. Someone would have waived the inspection just to get the keys. Buyers were desperate. Sellers were laughing all the way to the bank. Today, silence. No offers. No open house visitors. Just a slow, painful series of price cuts. $640,000. $625,000. $599,000. And yet, nobody is buying. What does this tell us? It's a sign that something fundamentally has shifted in the housing market. And what's happening now is far more dangerous and insidious than a simple correction. For the last 3 years, everyone has been waiting for the housing crash. You were told that once interest rates went up, prices would come down, that the bubble would burst, that homeowners would panic and dump their properties. But here's the reality. That crash hasn't materialized. Prices stayed high. Demand dried up a little, but not enough to cause a collapse. Instead, what we're witnessing is something much more profound. A slow, agonizing stagnation that could last for years. And I believe, based on recent data and economic fundamentals, that we are now entering the great stagnation trap of 2026. Welcome to Financial Stud, where smart money moves meet unstoppable success. Get ready to master your finances and unlock your true earning potential. In this video, I will show you the one critical data point that Zillow and Redfin are terrified of, something that signals a coming wave of inventory, falling prices, and financial pain for millions of American homeowners. If you're a homebuyer, investor, or just curious about where the U.S. housing market is heading, stay tuned. This could be the most important video you watch this year. The 2026 housing landscape. Why the crash is a myth. Let's start with the basics. Despite all the headlines predicting a crash, the data tells a different story. In 2022 and 2023, mortgage rates surged from historic lows of around 3% to over 7%. Many predicted that this would cause prices to plummet. But instead, prices have remained stubbornly high, especially in the Sunbelt states like Florida, Texas, Arizona, and parts of California. Why? Because demand in these areas was driven by long-term factors: remote work, population growth, and a shift in where Americans want to live. These forces haven't disappeared overnight. But what has changed is the supply side. Inventory levels are exploding, and this is the critical warning sign. The reality check. Why prices haven't crashed yet. In many hot markets, homes are taking longer to sell. The days on market are increasing. Sellers are lowering their asking prices, sometimes by 10%, 15%, or even more. However, what's truly alarming is the massive surge in inventory in specific regions. According to the National Association of Realtors, NAR, U.S. housing inventory has increased by over 70% since its pandemic lows. In some markets, like Florida and Texas, inventory has doubled or tripled compared to 2021. And here's the kicker. Builders are still building. Despite rising interest rates, construction permits remain high in many states, and new homes are hitting the market faster than buyers can absorb them. This new supply is a ticking time bomb. The root causes of the coming stagnation. Let's dissect the core reasons. 1. The golden handcuffs of 2021-2022. Remember the Federal Reserve's aggressive rate cuts in 2020 and 2021? They pushed mortgage rates down to historic lows around 2.6%, sometimes even lower. Millions of Americans bought or refinanced homes, locking in ultra-low rates for 30 years. This created what economists call the golden handcuffs, homeowners reluctant to sell because they'd have to buy again at much higher rates. Why sell and buy at 6%, 7% when you're paying 3%? This kept inventory artificially low for years. But as rates started rising sharply in 2022 and 2023, this dynamic began to change. 2. The lock-in effect fades. By late 2023 and early 2024, homeowners are finally feeling the pressure. Many with 3% or 4% mortgages are now considering selling, but they're hesitant unless they get a significant price boost or a better location. But the math is changing. Those who wanted to sell and buy again are finding that their new mortgage payments are 50 to 70% higher. Many are choosing to stay put, leading to a frozen market. 3. Rising insurance and property taxes. In states like Florida and Texas, homeowners are facing skyrocketing insurance premiums and property tax hikes. In Florida, insurance costs have increased by over 300% since 2020, due to insurers pulling out of the market and increased disaster risk. In some cases, homeowners are seeing their monthly payments grow by hundreds of dollars solely because of insurance and taxes costs they didn't anticipate. This insurance apocalypse is forcing many to sell, adding to the inventory glut. The data that matters. The inventory flood. Now, let's talk about the most recent and revealing data. The most critical indicator is the inventory trend across the U.S. In the Northeast and Midwest, inventory levels are still relatively tight. Prices are holding, demand remains steady. But in the Sun Belt, especially Florida, Texas, Arizona, Tennessee, the trend is stark. In places like Cape Coral, Florida, and Austin, Texas, inventory has increased by over 40% year over year. Some neighborhoods are experiencing 9 months of supply, well above the healthy 4 to 5 months. Builders are slashing prices, offering incentives like $20,000 in flex cash, or buying down mortgage rates. This is a parabolic increase in supply, which inevitably leads to price declines. Why does this matter? Because when supply exceeds demand significantly, prices must fall. And the longer this excess inventory persists, the deeper the correction could be. The myth of the Fed pivot and rates. Many believe the Federal Reserve will cut rates soon, bringing mortgage rates back down to 4% or even 3%. This is a dangerous misconception. The reality: the Fed's rate hikes are designed to fight inflation, which remains stubbornly high. Mortgage rates do not follow the Fed funds rate directly. They follow the 10-year Treasury yield. Currently, the 10-year yield is around 4.7% to 5%, which correlates with mortgage rates in the mid-6% to low 7% range. Recent data from Fannie Mae and Freddie Mac confirms that mortgage rates are expected to stay above 6% into 2026. This means buyers should expect higher monthly payments than they think. Refinancing to lower rates will be limited or unavailable for many. So, if you're waiting for rates to drop to buy, think again. The window for low-rate refinancing is closing fast. Many experts now believe that the low-rate housing market of the past decade is over for good. The 2026 Homebuyer Playbook. Strategies for survival. Given this landscape, how should you approach buying a home in 2026? Here are 3 core rules for navigating the coming market. Rule 1. The 90-day rule. Stop looking at new listings. Sellers still believe it's 2022. They think their home is worth top dollar, and many are still refusing to negotiate. Instead, use filters to see homes listed more than 90 days ago. These are desperate sellers, often motivated by financial pressure or personal circumstances. Offer 15% below asking price and be prepared to negotiate. Pro tip: the longer a home sits, the more flexible the seller becomes. Rule 2. Rent versus buy math. In many markets, rent is cheaper than buying, sometimes by 50%. Use this to your advantage. Save the difference and invest it. Put the savings in a high-yield savings account earning 4 to 5%. Why? Because patience pays. Waiting for prices to stabilize or fall further can save you thousands, if not tens of thousands, over the long term. Moreover, if you're planning to hold a property for 5 to 10 years, short-term market fluctuations won't matter as much. Rule 3. The insurance audit. In states like Florida, Texas, and coastal California, insurance costs are exploding. Before you buy, get a CLUE report, Comprehensive Loss Underwriting Exchange. Obtain a binding insurance quote before making an offer. Don't assume insurance will be affordable or that it will stay stable. Why? Because insurance can make or break your affordability. I've seen deals fall apart because buyers assumed $300 per month for insurance, only to find out it's $1,200. Bottom line: Do your due diligence on insurance costs upfront. The coming Great Reset. What to expect? The housing market of 2026 will be a story of two Americas. The Northeast and Midwest will likely stay relatively stable, with moderate price declines. The Sun Belt and West, once the pandemic boomtowns, are facing a hangover. The party is over. The lights are coming on. Many homeowners and investors will realize they paid too much for a declining asset. The biggest risk? Catching the falling knife. If you're a buyer, patience and due diligence will be your best allies. Watch the inventory levels. Look at the chart. Understand the supply-demand dynamics. And above all, avoid the trap of overleverage or rushing into a market that's heading for a correction. The next step: prepare for the 2026 recession. While the housing market takes a hit, another storm looms: a potential recession. J.P. Morgan recently released a warning about a 2026 recession that could wipe out your 401k. Why? Because the same factors causing the housing slowdown, rising interest rates, high inflation, and debt levels, are also threatening the broader economy. The stock market is vulnerable. The Federal Reserve's aggressive rate hikes are designed to tame inflation, but they also risk tipping the economy into recession. And history shows that housing downturns often precede or coincide with economic recessions. So here's what you should do. Diversify your investments. Avoid overleveraging. Keep cash handy for opportunities. Stay informed about economic indicators. Final thoughts. What you can do now. The next few years will be challenging but also full of opportunity. Key takeaways. Be patient. The market is shifting, and rushing will cost you. Do thorough due diligence, especially on insurance and property costs. Focus on motivated sellers and distressed properties. These are your best deals. Use rent as a leverage tool. Waiting could save you money. Prepare for a potential economic downturn. Diversify and build liquidity. Remember, the market doesn't move in a straight line. It's cyclical. The smartest investors and homebuyers are the ones who understand the fundamentals and act accordingly. Why this matters to you? Whether you're a first-time homebuyer, an investor, or someone watching your retirement savings, understanding these trends is crucial. The Great Stagnation of 2026 isn't a crash in the traditional sense. It's a prolonged period of low or negative price appreciation, high inventory, and financial stress. But with the right strategy, you can navigate this landscape, protect your wealth, and even find opportunities others overlook. Coming up next. In our next video, we'll analyze the stock market and discuss how the looming recession could impact your 401k. J.P. Morgan's latest warning is clear. 2026 could be a pivotal year for your financial future. If this sparked something like the video, hit that subscribe button, share with your friends, turn on notifications, and stay tuned. Because knowledge is power. And in this market, being informed will be your greatest advantage. Thanks for watching. Stay studious.